Hi, Ajat. Ajat, can you hear me?
Yeah.
Okay.
So people are already joining without this thing. I thought we have a control on that. Okay, as long as we can see and this. Well, I'm just testing the sharing.
Okay.
So do you see the screen?
Yeah, I can see that.
Okay.
So I'm going to use my deck, right? Because I made some changes.
Yeah, correct.
Okay.
So I'll start and a couple of minutes, 1 or 2 minute intro, and I'll give it to you.
Okay.
And then you do your stuff and then hand over the floor to me. Then we'll go from there.
Perfect.
Good afternoon, all. Welcome to today's session. We'll give a few minutes for folks to join. Good afternoon, everyone, once again, and welcome to today's session. We'll start in a couple of minutes at 2:05. All right, let's get starting. Let people join us. Okay. All of you should be able to see my screen, correct?
Yes, Ajay.
Okay. Good afternoon. This is Azad. Thanks for taking time to join today's session. We are going to talk about different strategies to secure our financial future. Now, what is going, depending on, we all are aware of what is going on now with markets crashing thanks to the unforeseen epidemic and COVID-19. And as a result, as all of our financial wealth is being depleted. We are seeing the markets crashing, and that is one of the major concerns. Suddenly, all of us are aware of the pain, and here we are trying to share some thoughts. So first and foremost, I would like to share this disclaimer. This presentation is purely a personal opinion expressed by presenters. That is myself and Venu. We have two speakers today, and it is exchange of ideas purely for educational purposes. Nothing presented in this session should be taken as a professional advice to either invest, divest, or take any financial decisions. Please consult your tax or financial advisor before you take any action. So please note that this is purely for educational purposes. Now, this is me, a couple of words. My name is Chandrasekhar Azad. I did my master's MBA from Osmania University, Hyderabad, did double major in computers from Institute of Public Enterprise. I was a senior executive in insurance industry in India. And after getting posted to Mauritius, because my wife was in IT, we decided to come here. And for the last 20 years, we are here. So I quit my IT job about 4 years back, and I'm full-time doing real estate and financial services advisor. Now, this is what is happening right now. Scary factors. So all of us hopefully are taking precautions and do the right thing. I know it is difficult, but hopefully all of us are aware of the situation, and we are all closely following. There's a ton of messaging going on in WhatsApp. There's lots of knowledge sharing, and also, but simple things is there's nothing to be worried about if we do some basic precautions. That is, protect yourself, don't go unnecessarily out, and hydrate well with this is proven to work well with warm water with the turmeric, black pepper, ginger. Our traditional Indian medicine works great. Add supplements because we are not going out, we are not having enough sunlight. Add supplements, vitamin supplements C and vitamin D. And of course, quality time. We have been asking for it, we got it. All the time in the world that to spend with family. Let's use it to bond, to have fun, to do whatever that's right for a family. Now, this is also a time to reflect upon, okay, at individual level as well as global level. As serious as it is, as tragic as it is, it has its silver lining and some of the unexpected positive consequences, whether it is from the point of pollution or from the point of giving us time to reflect and do the right things. We have all the time in the world for completing all those personal tasks which we have been postponing, either cleaning up one's home or doing this financial planning or whatever. So let's use this time. Now, today's topics we are going to start. We have two speakers, I said. Venu will be coming on in a second. We are going to have a stock market update. Basically, what is happening outside in the marketplace. All of us have been watching crazy stuff going on. Market crashing 39% to under 20,000 points down, and very quickly, like a V-shaped recovering almost about 25% in the last couple of days, thanks to whatever Fed is doing. Now he's going to talk about the market and what happened and what is expected to happen. And after that, I'll be coming in and I'll be talking about what are the different topics today we have. on how to protect our wealth. How do we make money in these markets? That is the danger, without burning ourselves. And how do we build wealth for a long term? And how do we get guaranteed regular income for a lifetime? So now I bring on board Venu. I'm unsharing. You can come. Venu, he is an entrepreneur. He is an advanced trader come investor. And again, whatever we are going to share here is purely from the point of sharing. We are not suggesting any trades or taking any action. Venu, it's all yours.
All right. Thank you, Ajad. Thank you very much. Let me bring my screen. All right. Good morning, everyone. Rather, good afternoon. So let me. Can you all see my screen?
We see mountains.
Okay, that's a very good sign. Okay, give me 1 second. Let me bring the. How about now?
Perfect.
Okay. All right. This is me. I'm Venu Chillarich. I basically, as Ajad said, I'm an entrepreneur. I had a Big Four consulting background. For the last 20 years, I've been doing a lot of technical analysis and financial markets, especially. And I'm an advanced option strategist. I do a lot of strategies in terms of the investments and making money in the market, whether it's a bull or a bear market. I live in Dublin. I have a lot of, as I said, a lot of background within the investments community as well. So with that, let me take you back to the market updates. Let's dive in right away. So we have seen a lot of wild swings this last few past weeks, and historical bull run almost came to an end. It's a huge run. And a new bear market started, coming in, and we are completely caught unaware of what's going on. With the conditions, a lot of them are changing so rapidly. There's a good chance that we are wondering what actually happening and what the experts are actually watching. So, are we going to say, we saw a lot, especially last couple of weeks, there is a bear, some kind of a quick bull run. Indexes are all went up very quickly. Let's dive in into clearly understanding what are the conditions that brought in. Are we expecting a new leg down, or is it oversold conditions? Is it like bear market? It's a very thin ice. You can't just go ahead and say, oh, you know what, everything has been sold, now I can go ahead and start buying everything. And especially, let's examine, is the buying in the bear markets, is it a dangerous or as an opportunity? So just I want to give you some quick snapshot of what happened. So this is an economic magazine, that actually, bi-weekly it generates some issues like, first cover sheet, if you can see on the top right-hand side, they say big tech 2 trillion bull run. And immediately the successive cover page was we are closed down, entire global. So that's the kind of speed at which we entered into this bear market. If you see the historically, last since 1982 till 2020, the COVID-19 bear market is a very rapid. Just within the 16 days, we entered into bear market. So all these things, what happened, and let me give you a quick update on where are we right now. So government came in and they passed the resolution, and they gave the CARES Act, which is like a $2 trillion they pumped in. And as you can see, there is across the wide variety of the categories. So they pumped some money. They basically brought a truckload of dollars, and they started pumping into individuals, small businesses, public services, all those categories, right? So if I want to compare, we had this kind of stimulus relief packages, if you will. These kind of things, they're thrown at the economy in 2008, recently during the financial meltdown, right? Compared to the GDP and what they released, the recent 2020 COVID relief package is like almost 9.3 times of GDP. So that is the kind of variation we are seeing. I can go into details, but just I want to give you at a high level what is the impact in terms of the economy and the GDP, right? And you're all aware of what's the kind of unemployment rate we are going to see very soon. So far, the numbers that were released were not really capturing the reality in the market, right? The unemployment rate is going to go very high very quickly because everything has been shut down so far. All the small businesses, you talk about the retails, you talk about the big corporations, everything has been shut down or working remotely at a minimum, a bare minimum operations level. So this is a chart that actually gives you a level of S&P 500 versus the unemployment rate. Again, the unemployment rate is a lagging indicator. It's not reflecting the actual reality in the economy. So we'll go a little bit dive into the how we got here. I just will take an attempt to see. This is the the red line here. What I'm showing here is basically is the overall high level. We got the very lengthy bull market that we got. And if you see the purple colored circle I made there is where we are right now in the S&P 500 index, right? So 2,789 is when it was closed last week. So basically it went all the way to 2,200 and there is a little bit good sign of coming up. So can we believe this rally and start getting into the market? I would like to hold on to those thoughts for a second. Let me show you what are the estimates the street is expecting. So here I captured all the top 5-6 analysts that are coming out with estimates on the Q1 and Q2 versus Q3. So if you can see across the board, everybody is saying we don't have a very healthy look of how we are going to feel for the coming quarters. So there was some aggressive estimates, like they are completely writing off 2020 altogether. They are saying maybe you can have some kind of positive signs early in 2021. So this is a snapshot of what the analysts are expecting at this point of time. Technically, we are in recession as far the majority of the analysts are concerned. Again, we need to wait and see how things are. The government has done a lot of initiatives in terms of pumping the economy and all that stuff. So it will take some time for the economy to start digesting these numbers, right? Let's dive in what is coming next. So this is the actual, I captured SPX, the S&P 500 index for the last, 3 months. So if you can see here, those lines, the green and the red arrows I pointed out across the blue lines, that was the range actually, that is the range that we are going to trade for the coming next few weeks. This is anybody's expectation, because we saw all the way down to the 2,200, and then it started pumping up, going up to a little bit upwards direction because of these so many activities that happened recently. On Thursday last week, Fed came in and pumped another $2.3 trillion in terms of buying the corporate debt and several activities, and basically they dumped another truckload of dollars into the economy. So that was the activity that happened that helped us to have a little bit pump up to the upper side. So the next week, meaning starting Monday, because we have a holiday on Friday, right? Easter holiday. So next week, Monday onwards, the next 2 weeks is going to be critical. Are we going to maintain the trajectory to the upwards, or are we going to have the range bound in that the two blue lines? Again, nobody knows. But again, based on the my analysis, I drew the resistance chart as a 2886. That's the level that we need to observe. If it crosses that level, then there is a good sign. There is a possibility of we may see some action in there. But again, this is, we just cannot take into one side of the equation to come to a conclusion, right? So again, what the key takeaways here? Yeah, there is some kind of gaining. So we have lost a lot of ground, and there was some gaining that happened that we just saw in the S&P. February 19th, we SPY and QQQ, which is a heavy Nasdaq index, they both lost by 70.3 and 15.1 respectively. What I'm observing is there is a lot of accumulation is going on. So I don't want to go into the details of the accumulation, but basically just for the sake of understanding, there is a lot of buyers in the market who are actually testing the grounds, and there is some activity going on. That's the reason there is a kind of SPX is going up a little bit, and the same thing on the QQQ also. Putting it all together, so as we talked about, Fed again came with a truckload of money and they dumped into the economy. Are we going to clearly have a lot of confidence on this rally? But again, understand, these kind of bear counter rallies are very common in the bear market. Are we going to see another double down? And again, this is all like, we need to understand let's take a step back and see there is a lot of impact on the economies of the sudden stop. All of a sudden, we were informed that all the business should be shut down, right? It is not like, just we can flip the switch and start the economies again. It will take a lot of time, especially if you're talking about the big companies. Supply chain impact is a lot. And especially in the small businesses, if there is no confidence, they are not going to make any revenue, who is going to go out and shop? Most of the retailers are already shut down. Only bare minimum online sales are going on. And again, companies are tripping to meet those demand. And I don't think a lot of people are opening their purse to start making higher purchases, decisions and all. So with all this accumulation, what we're saying is the bottom line, the odds of succeeding and analyzing the markets with just a P ratios and fundamentals, it's not existing. So what that leads to us? So that's where, I come up to the, Einstein approach. Einstein is not really into the stock market or any kind of investment, but I take his assertion, like, if I had 1 hour to save the world, I would spend 55 minutes in defining the problem and only 5 minutes to implement the solution, right? He said very well, and he's actually implementing that. He implemented in a lot of his things. And we all have unstoppable inclination to jump right away into the market and trade impulsively for first 55 minutes, and then allocate last 5 minutes to trying to figure out, hey, what happened, right? And again, it need not be like, I'm not talking about the day-to-day trades, but at least, when we right now in the market, if you see, any of the stock, Apple was trading at 330, now it's 200. Oh my gosh, it's very cheap, right? So that's the kind of impulse reaction I'm talking about. If you have already accumulated certain assets, right, ask yourself, are they safe? Dr. Einstein, if you call him to your house and ask him to take a look at it, he will say, hey, what is your asset protection right now? Do you have insurance? Do you have estate planning? Do you have retirement planning? Do you have college funding? Do you have a tax planning? So this is all called 55 minutes of defining the problem and looking into it clearly what's in there, right? And then financial planning. It is shocking during my conversations with many of the folks, how many of us actually do this on a regular basis, right? How do you do the market analysis? Is it like, WhatsApp group, someone told you like, pick this one versus pick that one? Oh, this is cheap versus that? Or do you have a clear methodology or you have a fundamental principle of how you pick it? Or do you have tested a methodology of that? And have you aligned that to your vision? So these are the fundamental questions, everyone should ask and be honest to those questions, right? And at the same time, do you have the investment routine and discipline? Like, how would you examine that your routine is working and it is yielding a clear-cut results to you? So these are the fundamental things we are talking about, and that's what it is leading, and that's the kind of discipline we need to have. And the same thing, I can go on. George Washington, when he was a kid, he was asked to cut a cherry tree. So what he did was he took 2 hours to sharpen his saw, and only 1 hour to execute it. So that's what we are talking about. We need to have a discipline of preparing what it is before you get in and jump in. So with that, I would open the floor for the question and answers.
Venu, actually, let's take question answers at the end.
Okay, perfect. All right. So let me hand over to you, Ajat. Let me stop the share. All right.
Okay, so thank you, Venu. That's thanks for the insight into the markets, and hopefully, like this pandemic will be behind us soon, and economic activity will return. But then we don't know. Market was running on all 6 cylinders, and suddenly a curveball in the form of COVID-19 hits us. That is where, whether it is at a personal level or at a macro level, things will come in our way. There's unexpected things. So the question is how well, at an individual level or at a country, how well we are prepared, and what is that we can do. Here today we are going to cover some of the aspects of that. And most importantly, it is a very high level, very quickly, because each of those topics is an ocean in itself and needs in-depth analysis and do any action that we want to take. So let's go ahead and see how do we do these things today, dive into these topics. But let me take 1 second extra and set the floor. Now, today's concerns, most of us, like we have this shrinking net worth of our 401ks we are seeing with horror, and suddenly questioning ourselves whether my retirement is at risk. Most of you who are young, you have at least 20-25 years to retire, there are no concerns. You will have to take some steps to put some solid plan in place. But for people like me who are ready to retire, we need to pay attention and see whether, and this is a huge concern, whether my retirement is at risk. Now, will I have enough guaranteed income in my retirement? Do I have enough life protection, especially because of COVID-19, because of the unemployment situation that is coming up? Suddenly people are losing jobs, and with that, they're losing the insurance protection. So that is a huge concern. And how do I protect my wealth, and whether I have enough for my kids' college education? Now, all this ties into, again, at a macro level, this is the US debt clock that is ticking. If you go to that website, you will see that just in about 12 years, we have come up from about $8 trillion of internal debt to right now about $24 trillion. But with what Fed announced in the last few weeks, an additional $5 trillion or so. Can you please mute, please? Thank you. Okay. Thank you. So it is expected that the internal debt is expected to rise to close to about $30 trillion in the next few months. Now, our society, especially, it is leverage. For anything and everything, we borrow. As long as your borrowing costs are less, you're okay. But suddenly there comes a stage, I borrowed too much to buy this huge mansion, and suddenly my job is at stake. Then what happens? I lose my home. And with that, whatever I paid down, whatever wealth I built in is lost. We have seen what happened in 2008. My fear is with this kind of economic activity, the impact to the economic activity this COVID-19 is causing, it's going to be huge, and we need to be prepared. Now, if you see the government debt this is how it has behaved. It was very high after Second World War. It has come down drastically, but in the last couple of decades, it's going up, especially in the last 12 years, it has shot up way high. And you see this change in the, monthly debt. Now, if you see this, this is where your average month 30-year mortgage rates, they have been coming down significantly. Now, if you see the debt part of it, the mortgage debt and home equity debt still make up very high. But there are other things which are student loans, which are getting really, really huge. Now, this is what is happening. In the last couple of weeks, we have seen what is happening, and 16 million people have lost jobs, and stock market is going higher and higher. And there is something wrong there. There is no correlation. That is, Fed is trying to hold the bottom by pumping too much money. Hopefully, they will be successful, but that all hinges upon whether countries, whether medical and pharmaceutical industry can come up with solution and all. Now, if you see this, here is a funny part here. Now, household, the mortgage rates, okay, the mortgages, if you see that in the recession period, it was so high. Right now, this is so low, pardon. Now, the challenge here is whether it is going to be here or with job losses, these home mortgages will start rising high, like what we have seen in 2008. Student loans as well, it's already at a very high level. Now, without these fresh graduates and people without having jobs, these two are the major dangers that we are going to see. Now, one estimate, COVID-19, unfortunately, not just impacting the jobs, but a lot of people, we are failing to see the impact it is causing to Social Security. Now, look at this. It is an unwitting casualty is Social Security. Why? About all those people who are losing jobs are not paying into Social Security. In addition, Fed has given a payroll tax holiday, and actually companies can postpone their taxes and come back and pay within next 2 years. Yes, if they survive and they come back, they pay good, but otherwise it's already, Social Security is already in a tight spot, and they've been cautioning that the trust funds are going to be exhausted in 2035, and if this situation continues, it may be worse. Why is this all important? Why is that I'm talking about taxation? Why is that I'm talking about internal debt? Why is that I'm talking about Social Security? Because these all tie together, which are going to impact my retirement and your retirement. Especially if you're young, you have to understand that Social Security may not be there for you the way it was promised. Based on the projections, in 2035, only about 75% benefits will be given. The trust fund will be exhausted. The people who are coming in, paying, will be able to support only about 75%. So we better take some action, because that was supposed to ensure a safe retirement. But when it was introduced in 1930s, the expected age was about 67 years long. But at 62 to 67, about 5 years. But now we are living all the way to 87, 92, depending on whether we are living in a marriage or individually. Now, it is clear that macroeconomic conditions are changing. So are we prepared? That is what we are going to address. Now, before we jump into the topics, I would like to spend a minute or two here. Life is not about one particular item, whether I have a safe 401k, whether I am able to invest in a good stock. A comprehensive plan takes care of all these areas. I always say that it is a pie chart. Each segment has a value, each segment has a meaning to it. So we need to ensure that we have done our estate planning properly. Estate planning, as you know, we need to have a trust so that the wealth doesn't go into probate, our kids don't go into foster care should something happen to us. A lot of people are not paying attention. It is very important. I have a separate session on that. So please take care of that. Without any amount of planning is meaningless if we do not have that simple protection. Same thing with life and long-term care. I do everything perfectly fine, but I don't protect my life, the breadwinner. Then something goes wrong. The visions I have, the planning I did is all meaningless without a proper life and long-term protection. Once again, can you guys please mute if you're not, please, thank you. Then we talk about retirement. How do we ensure that there is enough growth for the time that is needed? Because people are living, we are living longer and longer. Is my 401k and the returns that is giving enough? Especially when the markets crash like that, if I have to retire. In 2008, when the markets crashed, all those people who retired, it is a horror story because your wealth has depleted 50% overnight, and you have to withdraw from the depleted accounts. Those funds they have no chance of growing back because the money is already withdrawn. So how do we plan for that? College funding. Yes, a lot of us have heard about 529s. Some of us may have done something about it. Is that enough? Is that the best way to fund our kids' education? When do we plan for college education? Is it when my kid is in high school, or much, much before that? That is, we need to take care of that. Similarly, tax. I mentioned that internal debt is going to hit about close to $30 trillion. Federal government is not going to cut on Social Security or Medicare, or even if they have to cut, they have to do it gingerly. Why? Senior citizens are the trusted voting bloc. No party will be taking chances with them. So as a result, taxation is going to be huge, high. We need to protect in future if our taxation, instead of being right now at 18 to 22% effective, if it is going to be 30, 40, 50, what do we do? Don't think that is unthinkable. After 1945, the taxation in US history was 94%, because we were coming out of a Great Depression and the Great World War, and we were building all the infrastructure that is needed. So whether we go to that high level, I'm not saying, but higher taxes are coming. Same thing about return and risk in the marketplace. We have seen how suddenly all those bull market, like, okay, we are all the 11 indicators, economic indicators, were showing green, doing well, low unemployment, lowest in the 50 years history. Suddenly, just like that, COVID comes, and we know what it is. So how are we protecting? There are different strategies for the risk management. So my simple suggestion is this: each of us have to take time to do a comprehensive planning. It is not just about finding that what do you call, Amazon or Apple stock and investing that. You have to do all that investigation and doing, but a comprehensive planning is much more than finding that magic stock. That's what I'm saying. Now, as I already covered this, this is what I call a financial foundation. First of all, without protection, that is a basic foundation. Nothing is, rest of it is meaningless. Then ensure, especially markets are changing, employment situations are changing, ensure that we have 1 year of liquid funds. It need not be in under your mattress, but they're liquid enough to withdraw so that you are not in danger of missing a mortgage payment or otherwise. Then your safety investments, whether it is 401ks, whether it's your house or whether it's annuities or IULs, we'll talk about that in a second. And then comes your risky mortgage, your brokerage account, your investments, 401k, stock market, highly volatile. So this is what we focus on, essentially a foundation, financial foundation. Now, having known the macro conditions right now, did you protect your family? Did you do your estate planning? If not, please schedule an appointment today with whoever is your nearest attorney to complete your establishment of trust and do your estate planning. And do you have enough life and long-term care protection? This is very, very critical. I've been doing families planning for multiple families in the last couple of years. It's very, very tragic that even when companies have good benefits, people are not paying attention to. What will happen? That's kind of a thought process. Please do not overlook this important thing, long-term care. I'll tell my own story. I thought I'm cruising well, did very well. I have covered all those areas, but suddenly, boom, 2 years back, a rude awakening comes. My dad had a stroke, and suddenly it opened up my eyes to the kind of horror situation financially, not just the medical problem and the emotional problem for the family. Financially, it can be so huge that the cost can be as high as close to 300,000 by the time we retire, should there be. So that's a gaping hole, long-term care. No regular insurance covers, not Medicare covers. So that is when most important, we need to cover that. Then, do I have my retirement income? A lot of us are counting on 401ks, right? What happens if we retire when the markets are collapsing? That is what the planning is about. Did you budget for that? Did you account for downturn? how do we do that in advance? Nobody has a crystal ball. So how do we do it? Are there any steps that we can do? That's what we need to pay attention to. Now, I have a complimentary, personal financial strategy session. You can schedule it at that calendar. Now, today's topics. How do I protect my wealth? Can I make money in these markets? And how do I build wealth for a long term? Get guaranteed regular income for lifetime. Now, for people, most of you, if you have time on your side, at least 20, 25 years before retirement, you should not be truly worried about these ups and downs in the stock market. Okay, even if the market crashes, the history of stock markets in the last 75 years showed that they come back eventually. The long trend is about 6 to 7% uptrend. So you have time on your side, not really need to worry. But you can take steps to minimize that. You can take steps to ensure that when you retire, what should not happen. But when you retire actually, or when you are on the verge of retirement, if that bear market happens, the bear markets and bull markets have a huge impact. Now look at this. If you are retiring in a bear market, and if you are taking from your 401k about 5% withdrawals, then it is estimated that your it will wipe out, deplete in about 13 to 15 years. Whereas if you are in a bull market, like after 2012, then you have accumulated significantly well. Your fund can, your brokerage, 401k accounts, your retirement portfolio can last a long time, about 30, 35 years. So when we retire, whether bull market or bear market, has a significance, and we need to take steps so that we protect ourselves should we be retiring in the bear market. Now, how can I protect my wealth? We have been cautioning that we have been in a bull market for longest bull market, 120 months, so 10 plus years. And take some precautions, take some safety measures, ensure that you have some cash on the side, ensure that high value stock portfolios are a little bit trimmed, and do the rebalancing, all that, right? Now, cash is king. Right now, market is offering a great opportunity. Maybe in the next few months, it's going to be the same. But is it too late right now? Cash is king, yes. And that is the dilemma most of the even advanced pundits are having. Okay, if you have already kept significant cash outside, or if you have converted, or if you have reposition, rebalance, you're good. But if you want to convert the cash stocks to cash, that is a real huge dilemma. Because timing, nobody can predict. What if there's a V-market recovery, V-shaped recovery? Is it too late? So what I am doing, what a few folks are doing is, they're making use of these rallies to take some cash out, not all of it, so that you have some cash position outside. It is recommended that at any time in your life, you need to have at least about 20% of your investments in a cash position. Why? Market continuously offers those opportunities. Now, second, how do I protect? Key, diversify, not just across the companies, but across the industries, across the regions. What we have seen in the last 1.5 to 2 months, China has actually gone up by about 3 to 4%. And if you are diversified truly geographically, making your investments are there, and say Alibaba or China Mobile or whatever, you are protected actually to that extent. So asset diversification is very important. Again, across the asset classes, not just 401ks and your financial instruments, but your real estate, your land, and different other assets. Now, how do you? One more thing is, you don't want to take out into the cash and all. What other strategies, how you can protect? People hedge their risk. That is, you buy a put protection long side, or you have some significant portion in a gold, or you buy inverse ETFs or treasuries or money bond. Some of these treasuries and money bonds, they give very low returns, but they give you this high protection. So if you are concerned about market risk, if you're concerned about that, you can keep a portion of your wealth in those. Again, it's all about managing your portfolio, about how much of risk you can take and how much of protection you need. It also varies depending on the age, what you are. As you are growing older and older, you would like to have a higher profile, a percentage of your investments in these low risk categories, whether it is debt instruments or whether it is treasuries or money bonds and all, right? So that hedging itself is a huge deal. In this market, when markets was hitting high, people who had that foresight or people who are professionals, they covered themselves with the hedging positions. Now, second is long-term vision. Again, protecting wealth is all about long-term. If you have time on your side, that's what matters. Your investment style should be, wealth building style should be long-term. I believe Warren Buffett said, why is it so difficult if you if you say wealth building is so easy, why is that a lot of people are not so wealthy or not rich? And his answer is simple. Nobody wants to be rich slowly. We are all looking for that overnight kill of that amazing stocks. Did you buy Zoom? Did you buy this? We want that kicker, immediate gratification. And his philosophy is wealth building is a slow process. It's a simple process. It's a slow process. Stick to that. Now, how do I make money in this? Okay, you're talking about protection, yes. Are there any strategies to make money? I am sitting pretty and I want to make some money. Now, here are a couple of simple strategies. Again, there are a ton of advanced strategies, but I'm just mentioning a couple of them. They may not be for all, and there are a lot of risks that are involved with that, but I'm going to mention a couple of them. So for sell put options of the companies you want to own. Now, this is option strategies I'm mentioning here in your brokerage account, or if your IRAs permit if you have this advanced level of trading, this is what it is. I always wanted to own Boeing. I always wanted to own Apple, but I was always worried that it's always too high. But now market is giving me an opportunity that they're beaten down. Not just that, but I can get real good money. I don't want to go outright and buy, but I want to get some income, generate some income. So by selling put option, the money is deposited into your account right off the bat. That means you're saying if the stock price falls below this, I'm willing to buy. Use this strategy only to implement if you are sure about the companies you want to own for a long time. Right now, thanks to the volatility and marketplace, especially some of those companies which are in danger with high debt are offering exotic returns. How exotic? They're giving 20% return for 2 weeks, whether it's Royal Caribbean, whether CCL, whether AAL, so any number of them. But then there is a danger that they can go belly up. Are you willing to take that risk? Or you want to stick to these solid companies you want to own for a long, long time. So if you my advice is stick to the companies you always want to own. Then the money that you get, if the price falls below, you are excellent. You got the price lower than what you wanted to buy for. If they expire above that price, the money is in your account and the option is worthless. Second, you have this ton of stock which you got because you've been working for Apple for a long time or some of the other companies. Now, I want to make some money instead of just sitting on that. You can sell what is called a covered call option. But the danger with this is if your stock is bullish, very quickly going up, then if you sell that, when the price moves above that sell point, they are going to take away your stock. This works very well if there is not too much of a momentum on the upside. You are sure that the price is not going to go above way too much. You are able to make some money. Again, these strategies, they work beautifully, but do fully knowing that if the price go above, you are going to lose the stock. But if you are planning to sell the stock anyway, getting a higher 20% return is fine. If you are trying to buy the stock anyway, getting it for 20% lower is fine. So that's where they work. And then to get to this, again, money in the markets, there are high yielding stocks and bonds. It's amazing. Some of these companies which are so solid, they're right now, their prices are at offering 10, 15% of yield rate, meaning when the dividend they declare is resulting in 10, 15%. Solid companies which are not going to go anywhere. Say, for example, British Petroleum. Yeah, price may come down, the price may fluctuate, but as long as you hold it at this price, if you're getting it, you are getting a 10% yield. That is where are you going to get? Are they going to go belly up? No, oil is going to go down probably. So do you have the risk to hold it? That is, again, you have the option. Again, some of the other exotic option trades are available. If you want to do cautiously with less than 5% of what you can, and caution, know your risk tolerance. Do not over leverage. It is very exciting to see that 20%, but when it goes down, and if you have to buy it, if you don't have the money in your account, and if you are pledging your stock on a margin, then that is a dangerous situation. There is so much emotion there, that's why it is dangerous. But if you are balanced, if you know your risk, works beautifully well. I can say that this couple of strategies, I have been very, very happy about it. Again, nobody can predict the market. So I ended up having to buy it at a low. It hurts when you see that negativity, I'm in red. But when you know you want to own the stock for a long term, you are absolutely fine. So have that, write it down when you make the trade, why you did, and when you really have to own it, or when the stock goes out, you know that's okay. Now, how do I build wealth for a long term? Now, it is very, very simple. Some of as I already quoted Warren Buffett, it's simple, long-term discipline. If two people are working, can you live on one person's incomes? Can you diligently save the other person or what do you call income for long-term wealth building? It's easy to succumb to the temptations of consumerism. Consumerism and wealth building, they don't go hand in hand, unfortunately. At the same time, do I not live my life? Of course you have to. So that's where you need to save regularly, consistently. And again, stick to, if you're not an active person managing your wealth, analyzing all the stuff, stick to the low cost funds and dated funds, so that you are eliminating your emotion out and you don't have the time. You're okay. Time is on your side. You're good. And again, one more thing is, make a wish list of 50 stocks you always wanted to own. Today is the time, because market is offering such fantastic opportunities. Trust me, in the next couple of months, market is going to have some more correction in spite of all that Fed is doing. Unless tomorrow somebody announces they found a cure for COVID, even then the economic damage is so huge, the market is going to offer fantastic opportunity. Make the wish list of those 50 stocks you wanted to own. That is your own ETF, and accumulate, start nibbling them. If you don't want to buy them today, start selling a put option on that so that you get income. And if it goes below further, you get to own it at a lower price. Again, keep nibbling. There is no perfect timing. There are some great companies on sale right now, which just a couple of months back, people were screaming, buy, buy, buy. Now, right now, they are so beaten down. They're right now on sale. You don't need to necessarily wait for a perfect bottom when you know you are buying good, solid companies. And for long term, you build a real estate portfolio. That is, again, your different asset class, right? That is what we need to do. Or I'll touch upon it a little bit in detail in the next couple of slides. Now, for all of you, those of you who are wealthy, you have money sitting there in your checking account, and you have what you call means to invest more. There are pre-IPO platforms that are available. You can go ahead and check SharesPost, Oceanic Partners, EquityZen, MicroVentures, Forge Global. They offer a platform where even before the companies come out for IPOs, you can actually go and buy. But they ask for certain qualifications, certain evaluation. You should be high net worth individuals. You are not dependent on every month in salary. Your portfolio is certain level, and you are able to take certain high risk. So there, all those exotic companies which are making waves, which you hear them on the radio or TV, but they're not at trading, you can go ahead and buy them in advance. But again, it comes with its own risk. You do your due diligence whether you are investing for just in the hype or you truly believe in. Next, how do I get retirement income part of it? This is very important to have this conversation with your better support. First of all, why do you need monthly income, retirement income? Because you need to have regular, reliable monthly income, because Social Security is not guaranteed, it's not sufficient, pensions are gone away. We need to talk about it. Then people are living longer and longer. The nest egg may not be sufficient. That's why you need to. Then how much protected monthly income is needed in the retirement? So that depends on your projected living expenses. It depends on your projected monthly income in your retirement. And is there a gap? If you have been building wealth long enough, there probably you are going to have a surplus cash flow there in the retirement. In that case, your challenge will be on how to save taxes. So again, what about account for rising prices, huge inflation spikes, unforeseen healthcare costs? I talked about it, long-term care costs, right? Now, how much should be protected? Assuming this is how much you are expecting your monthly expense. Out of that, how much of income do you want it to be guaranteed, and how much you can take chances? Now, how do I build your regular monthly income for lifetime? There is a multi-pronged approach. As I said, build a rental portfolio because it is wealth building, as well as the rent is your income, regular income. Again, do not buy homes extending over leveraging yourself. Know your tolerance. If two people are working, you have to budget in such a way that even if one of the partners loses job, you are still able to withhold your rental properties. That's where it's important to ensure once you make the down payment, you have a positive cash flow. Don't fall in love with all the frills of the rental properties. You need to ensure pure hard cash flow. Do not overpay, and diversify geographically, because if it is a Bay Area high tech, if it goes bust, then you are in a problem. And if it is only purely auto industry in Detroit, you are in a problem. So having a diversification geographically is very important. Again, have a budget, a portion of your rental income, hide it away for maintenance and litigation costs, and have enough liability and property insurance. Liability is huge because you don't know what kind of tenants, what kind of situations, so have that proper protection. Next, one of the other means to get regular income is this IUL. IUL is Index Universal Life. This is one of the beautiful things that IRS has given. It is a tax exempt vehicle. It is a market risk proof vehicle. It builds wealth without market risk, without taxation. It provides life coverage and long-term care coverage. But it works well when these parameters are good. You have a good health, you have a good growth in that cash value. I'm talking about the wealth of that. You have a longer time period, you have a great growth in it. Higher the investment capability. This works so well for cash rich people and rich people. The more you invest, the more larger the wealth you can build in it. And from that, you can withdraw for monthly expenses. And anything residual is left out, it goes to your trust. So again, what is the value proposition? Lifetime protection, unlike a term or otherwise. Long-term care protection, which I already talked about it. There's a separate session I take which go deep into this long-term care part. Builds wealth, tax exempt, and it a significant upside when markets are going up, and 100% protection when the markets are crashing in bear market. That is the beauty of it. It protects you from the market risk, but gives you up to a certain extent on the upside. As a quick example, in this case, Tom, the guy who has retired, saved diligently in his 401k, has about $1 million. And for 20 years, he has withdrawn from this. There are 5 years, negative years. After 20 years, in the right bottom corner, 445K is what is left. Not bad, but assuming he's not withdrawing when the markets are negative in this 5 years, he has some other account like an IUL where he can tap for the living expenses. Look at what happens to his. The same 445 would be 3.6 million. It's not magic. It's a simple philosophy. When I came across this strategy 2 years back, it kind of blew my mind away. It's the simplest of simple philosophies. When markets are down, do not touch your 401k. Let it sit there, because when the markets come back, those dollars are going to grow, explode back. If you withdraw the depleted dollar, that has lost the opportunity to grow back. Simple philosophy, very difficult to implement unless you planned ahead. If you do not have another source, you are forced to take from it. So that another source is build an IUL with a cash value. That is a simple philosophy in that. So for a diligent long-term investing, say in this case, a 30-year-old, 500 investing for a long time, 60 years, you have invested 210K, but you have a cash value at the retirement 700K with lifetime protection, long-term care of 1.2 million. This again, under detailed session, you can attend that. The third one, which I've mentioned for long-term, what you call regular income, is annuities. Now, this annuities is not for somebody who is young, because youngsters can go the route of the market 401ks as well as these IULs, because that gives you a longer term, better return. But this works superbly well when people of my age, wherein they're ready to retire and they have cash sitting in the checking account, and they do not want to take too much of risk, and they know that they can lock it for about 10 years, 15 years. They do not need that money within that time. Works perfectly well. Consider an annuity which can provide you guaranteed monthly income that you cannot outlive. It is for a lifetime. Now, this is what we say is a promised return, and it gives the guaranteed lifetime income. Now, the couple of simple examples I quickly will go through. This one, a fixed annuity, you start with 200,000, lock it for 10 years, it goes up to 420K, from which you can get about 4.6% annually as long as you live. You do the math, 200, maybe in 10 years you are done. Again, is this the money in the stock market can grow very well? Of course it can. But then the stock market can also go down the way it is done today. And if that happens and you need to do the withdrawal from the depleted accounts, it's not good. So as people are approaching retirement, they slowly transition some of the riskier assets into the cash position. So this is where if you can lock it for 10 years, that cash position at 55, when you are 65, you can for lifetime, you can be. So insurance company is on the hook to pay as long as you live and as long as your wife lives or your spouse. So another one, an index, this is linked with the markets, and it's the same thing. It has a little bit of different features. It gives initially 25% bonus, and after that linked with the index, same thing. It has a little higher return after the wealth is built, and it also has a stepped up adjusting to the inflation from the time the annuitization, that is first time you start withdrawing, to as long as you live. So in this case, even though you started at 25,000 per annum, if you live long enough at 85, you are getting about 73,000 per annum. So is this what you need to invest, only this? And again, as I said, it's a pie chart. Each one has a place for it. You have your 401k, a place for it. You have a place for IUL, that is the tax exempt category. You have a place for your brokerage account, and you have a place for your rental properties, real estate portfolio. You have your social security portfolio, and then cash lying plan for annuities, another portfolio. It is about a comprehensive planning like that is what is needed. Why do we need to do this diversification? Should any one segment take a hit, you are not depending on one segment. By having this, for example, you logged down about a couple of 100,000 like this, you paid off your home, you still can, this is what you call fixed source of income. Now, there are many questions like this. So how do I save for my kids, and am I on track for secure retirement? Am I saving enough? And all these questions, this is what I do. Provide a financial needs analysis. So schedule your complementary personal financial strategy to know about these info and make informed choices. Basically, do your estate planning, ensure there's a cash flow, do the debt management properly. I do the comprehensive planning. Basically, I call it a financial physicals. If we are diligent, we are going once a year to doctor to have annual physicals. But how many of us actually have done a financial physicals? Time and again, I'm seeing people, they put it on autopilot. They're not even paying attention to their company benefits. That is the tragic scenario. So it is important, if we do not want to end up 20 years later, I should have done that, we need to do this. So this advanced planning is necessary. We need to know where we are so that we can take actions in order to go where we want to go. So this is me, Azad. So the contact information. Now I open the floor for any question answers.
Hey, this is.
Yeah, go ahead.
I have a couple of questions, one for you and one for Venu. For you, the one where you were showing that 401k 4-year negative, the person doesn't take out the money, and then the impact is huge. But on the other side, IRS forces you to withdraw money from 401k, let's say after you pass a certain age.
That is 70 and a half, which is increased to 72 years from this January onwards. That is called required minimum distribution. Go ahead.
So let's say if you were 73 in that case and you are in a bear market. So you are in a bear market, you are forced to withdraw that. So how do you take care of that aspect then? Because you have to take it out, you have no other option.
Yeah, basically it is a percentage of it. So that is where what you can't help it, there's nothing. So specifically, whether are there, what do I do? Because either way is in the bear market, I have to withdraw. So that is a situation, you have to withdraw certain percent, you can, but you can withdraw that and invest somewhere else. That is what you can do.
Okay.
Yeah, because if it's a bear market, you can also find other funds that you could put in that are even, slated to get better returns. It could, you could just put it into a Roth IRA or something, right?
Yeah, basically he is in a retirement and 72 years. So that is where the options may be limited. He may want to do or he may not want to do. So bottom line is, this is where it is important to know. So you nailed it in a way. There is this absolutely mandated minimum, distribution that you need to take, right? Whereas in an IUL, for example, the amount of whatever wealth you build, when it's in the bear market, it is not impacted. And if you don't need it, you don't need to withdraw. So you are protected there. So you have a distribution, have a percentage. That's what I can tell you. IUL doesn't have the RMD constraint. That's what I'm trying to say.
Okay. All right, got it.
How much is it that you have to withdraw? I don't know.
They have some percentage calculation. I'm not a CPA, but we can quickly find out that.
Okay.
So the question I had for Venu was, when you were showing those charts and the way on one side there were those projections from different institutes that this is what will happen in Q2, Q3, Q4. On another side, you had your own projection where you were showing that, okay, this is probably the expected in next couple of weeks or next few weeks, it will trade around 2880 something. Right. So one is, are they not contradictory to each other? And second is that, I mean, what do you think is the reason that, what is your own inference that why the stock market will rise so much while, I mean, on the ground, we are still in a bear market. There are so many unemployment rather increasing. There is no, as such, let's say, happy news from the COVID side. Then is there a reason that why the market for last 7 days or 10 days will increase so much?
I don't think
that's-
Venu said it will go up significantly. In fact, Venu, I remember you said caution.
Right, exactly. So, Amit, that was an excellent catch, and that's a good question that you have. And it is a genuine question that everybody in this form and in the market also has. So, one, I'm showing the chart screens where I'm projecting the resistance, and another slide that has the estimates, where I'm showing, let me bring, if you want, I can bring the,
Go ahead. Audience, if you have any questions, you can type in the chat as well. I can read it out and answer.
So can you see my screen?
No, not yet. Yeah.
Yeah.
Okay. So this is the estimates you are talking about, right, Amit? So these are all golden, all the top analysts, they gave based on what was happening and how the businesses are doing for the several companies. So they came up with estimates for the next 2 quarters, right? And the other thing I was talking about, this one, where this is my own technical analysis on SPX. And what I'm saying here is, if you see, SPX and SPY, I'm more do the same thing. SPY is the ETF for the SPX. So SPY, if you look into the pre-COVID-19 crisis, it was at trading at 340, right? Just multiply with the 10. That's where the SPX comes out. Okay. So the ETF is trading at 340, and we tested during the just next 2 weeks of the every day the 1,000 points market was going down. We tested all the way to the lows of 218 in SPY. Okay, and what happened? We tested. We started going up because of the several actions that were taken in terms of government, which is pumping truckloads of the money, be it the CARE Relief Act or the number of test cases coming out and stabilizing, the several news conferences that are happening. Stock market is actually acting every day differently. So especially for the last 2 weeks, to answer your question, why it went up, that's the phenomena. The market is always trying to react on the news, especially when there is no certainty. It always acts on what is happening on the next. That's why, if you remember, I was telling you what is critical, not the why. So people mentality is on what is like, okay, what company has actually, the government has pumped certain money, so it goes up. And there is another news conference saying that NYC cases are slowly going into downtrend. Yep, it goes up. So that's a comfort. So in the short term, what I'm talking about is right now, if you see the lowest is 218, and if you look into the technical analysis of the Fibonacci series, which again, this is most of the technical jargon we talk about. Those 3 lines I pointed out in this chart. One is at 38 point and another is the 50%, right? So 50% is called the head resistance. Normally, if you are in an uncertain territory, it is difficult for anything to go across this 50%. It will come back to the either 38.2 and rest there, or if the news is not encouraging for next week or 2 weeks, it will go again all the way to the down to 18, or it may go even down further also. So that is what, again, I'm talking about in this particular chart, because this is a daily chart, it is going to go in that direction. But the other chart is more about the analysts who are talking about the long term. The Q2, Q3, and Q4 is way ahead, like, from here, another 6 to 9 months we are talking about. Did I answer your question? So this is in the long-term scenario. This is on short-term scenario. What's going to happen next? And this next, the lows could be tested this week, or we may not even test the lows. We can go all the way up, because depending upon whatever is happening. Let's say there is tomorrow another company comes out and says, hey, I have a magic pill or magic vaccine, then that is a very good news for the market. And everybody starts, oh, you know what, this is the bottom. Let's go ahead. But they may not understand, as I said, like, it's not a switch and flip, the kind of thing. There are companies, there's a lot of businesses are already stopped. The impact is still coming in. So these, in the bear market, there will be counter rallies. The counter rallies will be sometimes go all the way to 50%. But you cannot trust those rallies. That's all I'm trying to say.
Excellent, Venu. So again,
Okay.
I'd like to point out that the focus should not be on a day-to-day market movement so huge so that we get worried and take drastic, actions. The purpose of this kind of sessions is to focus, bring back the focus at individual level to have a comprehensive planning. If you have a solid plan in place, this market ups and downs should not be really hurting or really bothering you. So anybody else have any questions? Somebody was talking when I was, so go ahead. If you have a question, go ahead and ask. Again, this is what, in order to, have the peace of mind, we first need to have our planning in place. Let's know what is our debt profile. Let's know what is the way we are burning the cash out, what is our income flows, and how we are investing in different categories of tax now, tax deferred, or tax advantage, and then extrapolate into future and see whether there is a negative impact, whether there's a cash gap between the income and expenses, so that we have time now to take action. Okay, that this personal financial strategy session for 2 hours is a complimentary session that you can go ahead and book it on my calendar.
Hey Venu, this is Anil.
Hey, Anil.
Hey, quick question. You were talking about SPY versus SPX, right? So they are basically the same thing, right? Other than maybe you're paying extra fees on ETF, I guess.
That's right. Actually, SPY and SPX is S&P 500 index, right? SPY is the ETF component of the SPX. To answer your question, yes, both are same.
Okay, thank you, Venu.
Yeah, Azad, this is Cecil here. I have a question regarding the mortgage rates.
Okay.
Yeah, so even though the Fed has brought the interest rates that they lend to the banks to almost zero, why hasn't the rates trickled down to the consumer level? So for example, if you're talking about our 30-year fixed or 7-1 arm and so on, they're still at the same levels they were before this recession kicked in. So do you see rates going down in the next few months? Because I'm planning to buy an investment property, so that's why I'm trying to gauge these rates.
Yeah, that is a very, very, very good question. So people are breaking their heads. How come Fed is going all the way to zero, and why is that in the marketplace the mortgage rates are not what it? In fact, the mortgage rates have firmed up a little higher in the last few weeks. Again, how it works is it has different factors influencing it. It's not directly just the what it is the Fed is doing, but what the lenders are perceiving in the marketplace, and the amount of rush there to do what do you call refinancing or so one is on the demand side, another one is also they are what do you call anticipating or expecting the risk profile, thereby that rates are not truly reflecting what Fed is giving. So my guess is if the situation improves and Fed continues, then you should see a little bit of softening on the rate.
Okay.
Yeah. So just keep the money ready. What you if you're talking about taking money from your existing home in order to have money for investment property, then that is different. But if you're waiting for the rates to come down, you already have the down payment, and then you want to go ahead and buy, that is a different case. Again, we are in such a situation right now from the point of investment homes. The situation is fluid for the next few months. We need to get the what do you call what kind of impact this is leaving. If it is a quick injury and we can heal it, fine. But is it causing a huge unemployment which is going to last, the pain is going to last for a longer time, then the impact is going to be something different. So great time to buy primary home from, because you are getting these low rates. But investment properties, we need to what do you call carefully parse through what kind of properties we are acquiring.
Okay. Yeah. So the government was proactive and then reduced the rates, but I think everybody is waiting, right? As you said, waiting to see if this will be like an injury or whether it will be severe damage.
Yeah. And also there's a huge demand for the refi and all. That's also the lenders are not able to cope up with the demand.
Okay.
And we remember what happened in 2008. We blame the financial industry lenders. They've been too slack. That's why we accumulated all those bad debts, right? Now they're being on the other extreme end, making it harder and harder.
Yeah. Yeah. So one more question I have, Azad. I have some cash sitting around. So
can we take the personal individual cases offline so that let's restrict the session to general questions? We can talk offline. Ping me or text me. We can talk later.
Sure. Thank you, Azad.
Okay, we have a couple of more minutes. Anybody wants to ask any questions, but look forward for different sessions in the future. And if you have any feedback or if you have any specific questions, concerns, drop a line. You have the information, either text or email, that's perfectly fine. But if you are interested in taking advantage of this free consultation of 2 hours, where I go dive deep and make you see what are the areas that you are not protected, and how, if you're doing very well, I'll advise you, I'll show you what you're doing is right. And then we'll talk, that may, what you call, raise questions about your tax liabilities, how it is going to have an impact and all. So basically it is a 2 hour, no frill, no conditions, nothing attached. It's your time. So take advantage of it and bring all the questions that you have.
One question I had is which are the sectors that will go up, if the market recovers, or basically even if it doesn't recover, it's going to be a bit stable. Like I've been saying that the biotech, whether you invest in ETFs like IBB, these would be the best sectors, which is not only from growth, but also from any kind of downside that can even still happen.
Yeah, there's as you know, there's a rush that to all the biotech industry, and all kinds of names have seen their stock price go three times, 4 times up in the last 1 month on the hopes that they're working on this what do you call, Rengen, for example. It shot up so much. So whether it pans out tomorrow or not, again, those are the speculative bets. When you ask me what industries will survive, stick to the industries, stick to the companies which are needed, which have solid, strong financial foundations where they're not going to go anywhere, and you are going to do well with those. The names are all familiar names, and whether it's in the infrastructure, telecommunications, whether the IT part of it, these companies are not going to go anywhere. So I would stick to those instead of trying to chase some exotic companies wherein the opportunity to make multifold is there, but also to get hurt is also equally. So coming to the 5G is going to be there, it's going to be big. The telecom companies, they're not going to go anywhere. Oil industry is very badly impacted. Stick to some of those big names with solid, balance sheets, and IT companies, whether you're talking about any of the familiar names, Amazons or Apples or Facebooks or Googles, they're not going to go anywhere. They found, and they have so much free cash flow that's going on. In fact, Amazon is, as you know, all of us are using, it's gone up actually. Now it's above 2000 again. So individual stocks apart, stick to the industries and segments which are going to be there for a long time. Of course, you need to have certain capital allocated to take risks. That's what we should do. But for the long-term planning, that's what I would advise.
And is there any plan to give out the slides to the folks who have registered?
No, this presentation, I was specifically cautioned advised because you do not know where it will go, what it is. As at the presentation's beginning, I had a disclaimer and all. So without that, you don't have any control. So I'll not be able to share the presentation, but we can talk any amount of time. You can schedule the time or in the future sessions and all. Any specific query you have, give me a call or schedule a time, we can talk about it. Again, do, whether you are doing with me or not, do these few things which I pointed out. Do your complete, will and trust, have it in place. And do this personal financial physicals at least on a regular basis so that you are covering your bases. As I said, I thought I did all the planning in the world and I was cruising. A curveball comes in and says, okay, what if something goes wrong like this? The amount of wealth I'm building can be evaporated very quickly, or at least can cause a huge dent if there is a long-term care scenario or stuff like that. Or take the current COVID. Nobody expected at a global level this can cause so much damage. So for people who are well diversified, have strategies in place, that is good. And plan for the retirement now rather than when you are at the verge of retirement. I can't emphasize that more. Had I had this knowledge 20 years back, I would have done things a little more differently. We did pretty good, but could have done a lot better, right? From the point of how to transfer wealth to kids without taxation, how to protect ourselves, how to invest better, how to cover our bases. So please do take some time. We have all the time now given. Do some planning, put some plan in place. How do I cover all my bases? Project yourself into future and say, okay, at this point in time, this is what I'm seeing. And then put a couple of scenarios. What if there is a 30% meltdown? Is that scenario still valid? That is what the purpose of planning is.
I mean, why don't people get some home equity line of credit, when they have jobs?
That's a good one. A lot of people are doing it, but think about it. You take the money out, you lose the job, and
you don't need to take the money out. It's just a line of credit.
Yeah, line of credit, you can have a line of credit ready for it, yes. But do you know something? Banks are also smart nowadays. They see that they keep running your profile in the background. And in 2008, it happened. I had a line of credit on my Mountain House home. I'm not using it and all. I had a 60K line of credit thinking that I'll take her. After 6 months or so, suddenly it vanished. The bank closed it based on macro conditions, and because you're not used it, they just closed it out. So they're also doing their due diligence. If you lose the job, and if there is a situation, they fear that you are going to take money out and then foreclose on them, they can foreclose the loan, I mean line of credit, before you use. But that doesn't stop you to take it now. And a lot of people are taking a home equity loan so that in the marketplace they can invest. Again, you should know what you're doing, what is your risk tolerance. As long as you know, you're fine. A lot of times you think you know, then you get hurt also. So that's what it is.
Yeah, Azad, this is Anil. So I had the same thing happen to me as well. So, I mean, unless you really cash it out, like you said, right, there is no guarantee that that home equity line will stay around. So that is very possible. And if you take it out, it means you start paying interest even if you don't need it, right? So that's a double whammy.
I have somebody right now asking that question. I already took the loan. Now I'm incurring the cost. So how do I invest? Where do I invest? Should I go and invest right off the bat? Right?
Yeah, otherwise you take it for a few months that you're paying cost with the uncertainty involved. And if it job situation improves and all that, you can put it back basically.
Okay. Last question. Anybody? We are going to close. Okay. Thank you guys. Thank you for taking time to join us this Sunday afternoon. Please do take a moment to drop a line or ask any question. Hope to see you guys sometime in the near future again on this web session. Thanks a lot.
All right. Thank you.
Thank you very much. We enjoyed.
Thank you. I appreciate it.
Thank you, Azad. Bye.
Thank you.
Thank you.
Thank you, Venu and Azad. It's really informative session. We really enjoyed it. Thank you so much.
Appreciate it. Thank you.